Welcome everyone to our webinar Tuesdays. We were just talking about the general market as of right now. We will talk about prop wealth and the few companies, Nfinity, which we represent. We'll generally talk about how people find out, they do their search, but we will also importantly find out what is the definition of a good suburb and how does it matter. Hi Julius, how are you? Evening, how you been?
I'm good, Parag. How are you?
I'm going very well. Thank you very much. Good. It's a good evening, right? And I think this is the first time we are doing in different locations. So I'm sitting in Cairns and you are in Sydney, right?
Yeah. It's a bit different, but let's rock it today.
Yeah, I know. But yeah, lots of good things happening in the market. I believe we are at a very different juncture. You know, a lot of stuff happening, a lot of people moving around, a lot of properties moving around, suburbs changing, locations changing, states changing, different momentum at every state. So there's a bit. What do you think? What's happening in the market?
Markets are still tight. The inventory is the biggest issue. Rather than inventory, the bigger issue which we are facing is the price point,
Right,
because till last year we were able to secure lots of properties in between 400 and 600.
right.
Since this early this year, that the 400-ish mark new normal shifted towards the 500. That's a new benchmark.
Yeah,
And then inventory started falling in between 500 and 600 now.
yeah,
So from last 3 to 4 months, most of the investors are struggling to find out properties ranging in between 550 to 650. 600 is a new normal. Now the biggest question is where to find in $600,000 price guide. There are markets which are available in that prices, but they are a super regional, or the type of properties which are coming up in that price guide are not actually a suitable properties to spend, or they're not worthy to spend around $600,000. It might be a momentarily dip into the inventory, or might be just because of the schemes and the
yeah,
people are not trying to sell because everyone is expecting the prices will move on from
yeah,
here.
yeah,
So this sometimes we have to be very careful about in which pocket to go for, and then what kind of property you have to buy.
yeah. I understand
At
that.
this stage, because of the extremely low inventory, we are thinking like, okay, 600 is not a big amount because entire country is moving. But if you take the entire 600,000 loans over the course of 30 years, then it's a huge amount
Yeah,
to pay.
yeah,
So when we are not certain about certain locations, we don't try to get into those locations where we think, okay, yes, at this stage, 600 seems normal for that location, but is it worthy in terms of the data? Like at this stage, demand and supply will have a lot of gap, but yes,
yeah.
how is the affordability? What are the incomes? Whether the socioeconomic changes are actually happening? How is the economical diversification, job employment diversification? There are a lot of
True.
challenges into those long-term growths. Uh, so, so the new market trend would be the asset types are changing now. So previously, in most of the capital cities, significant urban areas, or good major regional town center, whatever the properties we were looking at in between 400 and $600,000, we used to get it
Yeah,
first till last year. We used to buy it for 4 bedroom, 2 bathroom. Then it comes towards 3 bed, 2 bath. Till mid this year, it will be in between 3 bed, 1 bath. Now, or rather than
yeah,
focusing on the similar properties in the super regional location, into the great location where the population is good, population growth is pretty good, plus the incomes are stable. They have a healthy economy. Rather than buying this type of assets in a super regional area, rather we have to change the asset type. Like sometimes we have to buy strata townhouses or the non-strata townhouses or 3 bed, 2 bath subdivided properties in a good locations where that asset type will have more value than getting into a super regional or the areas where certainly they don't have fundamental. But since the property prices have moved up so much that 600 is becoming a new normal, doesn't mean that we have to get into that location and buy the property. So that is something which is changing a lot into the property market. So for next 6 months to 1 year, there's
yeah,
going to be a big paradigm shift between the asset types. So we were buying, or we were expecting a lot of assets in between a bigger
Yeah.
land, and then older houses. There's all the composition is going to be changed because suddenly you have a growth because that entire location makes a difference, not the houses sometime. That means you go
Absolutely.
towards the inner CBD and you buy a townhouse where it has much more growth than you go towards 1,000 kilometer from city and
Right.
buying 5,000 square meter land doesn't have any value. So that asset types are changing, type of strategies are changing. So this is something which is happening into the market.
That's true. In fact, that's correct. So, and not only that, choices are changing. People are more open. So, and I think last 2 or 3 years, this term boundaryless investors has come in, which typically means that maybe in last 4 years, 5 years, that people are more open to investing interstate in the states which they don't live in. Forget the states, even in the city in which they don't live in, and they are able to find properties. They are able to open their mind to invest into properties in a different area. They are able to invest into different suburbs, different states, able to research, able to see what suits them, able to see what budget suits them, and they are able to drive that. That's driving a change in a neighborhood investment to a boundaryless investment, where people would are looking at more opportunities. And that's where this whole asset class thing is coming in. That's where I suppose there has been an impact in some assets which have gone down, like especially like units, which are very rare to go up, or they have to be really at a great location to really go up or make some impact on what they are doing, whereas other assets are having a relatively much easier access, like houses. Townhouses are still in between somewhere, so that's changing. Then states are changing. Some great sub states which have been sleeping, South Australia and Western Australia are a prime example. They've been sleeping for 10 years, I suppose, and then suddenly the boom in the last few years has changed them to taken them to some other location, so some other direction. So it's a good mix of market which is coming up, and which has happened. And I think that's an interesting bit which we will all see in the coming few years, about how it moves, and maybe in the short term as well, with what RBI is doing. And it's a kind of a seesaw. Every month we hear, okay, this time the rate cut will happen. The next month you say, oh, this time the rate cut is not happening. Till about a month back, or maybe 20 days back, 3 weeks back, it was like RBA is not going to do anything, and then there is no rate cut expected, and then we are going to have something in Feb or March, something next year. Then suddenly, with the inflation data, it came in that the rate cut is very likely to happen in November. Then again today, there is after these the new data, which the quarterly inflation data which has come in, which is now pointing to RBA saying, okay, we are not going to look at a rate cut. So lots of stuff happening in the market. Politically, geopolitically, stuff's happening. Trump's doing his own bit to disturb the market or enable the market. So lots of stuff happening. But it's a good time to see how it moves, and we hope it moves positively for all of us, right?
Yeah, things are looking positive at this stage because of the fact that there are a lot of major construction projects happening across the capital cities. Similar, like in Perth, you still have a MetroNet project. It's going to be delivered by 2032. So most of your construction workers are busy. In Sydney, your new airport is not ready yet. A lot of workers have been already occupied into those type of projects. Similar, due to during the Olympics, there will be a lot of construction workers going to be busy. Brisbane's major mega project. So when this type of things have happened, that time the
Yeah.
construction cost will significantly go up, and that is going to be make things worse because supply side is already lower, except pockets in the country. Even though there is enough supply coming up towards the
Yeah.
Kumera, a few pockets of the Brisbane. So they might have some challenges in future next 3 to 4 years, whether that supply is going to be caught up with the more amount of population which is coming up, whether it is going to be oversupply, what kind, how we're going to match up with the construction cost. So it's a little bit dicey in few pockets, but yes, there are a lot of pockets where we still see the inventory is extremely low and the new supply is pretty limited, or it is not matched up with the absorption rate where the amount of population growth is coming up. So yes, few pockets are going to make wonders. few pockets might be stabilized because
Yeah.
affordability is going to be hit.
All right. No, that's a good, interesting take. I think we've already 3 minutes ahead of our beyond our time. So to start today, so welcome everyone. Welcome to our webinar today, webinar Tuesdays, and we are thankful that all of you have joined us to listen to us and ask your queries at the end. Very, very, very warm welcome to all of you from wherever you are, and you're hooked in. And we've got quite a few number of people, more than 500 people sitting in the webinar already. And I think we'll not wait for more. Let the other people join in at their own pace, and we'll start on this. All right. Welcome to you guys. Welcome again. For those who joined in new just now, we were just talking about the general market as of right now. But let's go on. So just before we go on to the in depth of the webinar, just a quick disclaimer on your screen today. This information, whatever we share today, will be very, very general in nature. None of this information takes care into your financial circumstances. So if you're looking at something specific, please talk to the professionals, whoever you like, whether any one of us or anybody else. Please feel free to talk to them and take their specific advice as per your circumstances. But we'll talk general in nature, and we will talk a lot today, and we'll hear from you a lot today as well. So, okay, that's what we are gathered here for, just to find out how to really find out the best suburbs for investment across Australia. That's the big question, right? I want to invest, and I really want to invest into one, too many properties, but where do I invest? How do I invest? And how do I find out that this location is the next winner? Which one is the next $1 million suburb? That's the $1 million question in front of all of us. So anyway, so very quickly, let's move on to the agenda for the day today. We will talk about Prop Wealth and the few companies, Nfinity, which we represent. We'll generally talk about how people find out, they do their search, but we will also importantly find out what is the definition of a good suburb and how does it matter. Is the definition of a good suburb same for you and me as well, or it differs? We will talk about what are the key things in a good suburb, key matrices which are there in a good suburb, some case studies about how do we really define a good suburb and why does it change. Then we look at one of the tools available in the market to really find out about a particular suburb and how you can do some kind of an analysis and learn whether the suburb you're looking for is good or not. Then we'll also look at the next locations which PropWealth has been recommending to its clients, and these are some of the latest lists which we will talk about today. And maybe you can, if you're looking at any of them, that's you feel free to have a look, but they are not catered to everyone's scenario, everyone's circumstances, but we will definitely be talking about them. And then the best part of this webinar, the question answer session. So we will have your queries about your existing investments, your queries about your existing properties, or anything future you want to do, or anything you've come out in this webinar, which you've learned in this webinar, or you want to learn more. Please feel free to ask as much as you want. uh, just and we'll go forward from there. Okay, very quickly, just the introduction about all of us. On your screen, on the other speaker is Julius. Julius has been is head of research and property acquisition at PropWealth, and he's been in the industry for quite some years, more than 15 years in the IT industry. Invested in New Zealand and Australia. Quite a experienced guy, and a lot of people who are in the investment circles know him very well in terms of his data research and his bit about how to find out how much he knows about the industries. And you can find out, you can off the cuff ask him about any suburb, and you bet he would know about it. So just maybe take a try at the end. It's a good way to find out. Myself, I'm a mortgage broker, and I've been lucky that I've been in top 10 mortgage brokers across Australia for the last few years, and have I've been very, very lucky that I've met some great clients in all this while, who have helped us achieve what we achieve, and we've been serving our clients for many, many years now. Prop Wealth is what Julius represents very quickly. There's a premium buyer agency, one of the fastest growing buyer agency today, with footprints across Australia, offices across Australia now. Looking at last 12 months, phenomenal number of deals which are being done, and I think in the next 1 to 2 years they'll be the number one buyer agency across Australia, and the way they are growing right now. Infinity Financials have served thousands and thousands of clients now. Myself and my partner Mudit, who's a guru in first home buyers, so many of them who really swear by him and want to talk to him. So we are all there. But today is not about us. Today is all about suburbs. What are good suburbs and why are we really wanting to go? Okay, so let's get into this. Okay, let's get head on into this. Why are we now suburb hunting? Why do we really want to know? Okay, what are the good suburb to invest? I can just invest anywhere. That's what I used to do 5 years ago, 7 years ago. If you have a friend or somebody who's invested, they would have gone to the next door suburb, or somewhere where a friend lived, or at best somewhere where uncle or auntie or cousin or somebody lived, and they would have said, oh, there's a house coming on my street and it looks good, my suburb is good, and properties are very good here, so you go and buy it there. That's it. So why now this dream for suburbs? And because we all know there are four key pillars for investment. And that's why the drive for knowing better suburbs, how the suburbs can grow faster, where can I invest comes in. And very, very quickly, the four key things, and I'm not going to dwell too much on this, but just to give you a reminder, four key pillars which we look at. Obviously, the strategy, most important pillar, the way you drive it, your strategy about how a property portfolio should be created, what do you want to achieve, how should you achieve, what do you want to do for that. Part of that strategy comes loan structuring, interest only, principal and interest, term of the loan, equity, all that comes in there. And then the property ownership, whether you're buying under individual name or trust or something. And then last and not the least, property. That's the important one, right? The property. Where is the property? We've done all the structure, we've made all the strategy, but where is the property? And that's where the next corollary comes in. We want to know the suburb. All right. So when we want to know the suburb, what we used to do? Just what as I was just talking. How do you begin your search? So what's the one thing which most people have been doing in all these while? Most of the people, what they do is they will go by media articles, they will go by friends and family, they will go by, or just Google it. You will find hundreds of articles through various agencies and people who write about property investment, and then you can go through it and see, okay, what's clicking, what's not clicking, what other people are doing, what they are not doing. So all that bit comes into your place, and that's what people do with their search. And but they may be right, may not be right, may be correct, may not be correct, but that's the way people will aim for, and that's the way people aim to look at properties. But is it the right one? Is it the right way to find a property? Is it the right way that you go ahead and search for a property? And that's what we are here to find out. We are here to find out what is the definition of a good suburb. Good suburb, again, two parts, okay? Something where I want to live in, or something where I want to invest. Two different things, very, very different, and the definition is different. Why? Okay, let's see. Definition of a good suburb. When I'm looking at living in all probabilities, I want a good school nearby. Most of the people would look at where can my kids go to good schooling. Whereas if I'm looking at investment, is it affordable to me or not? It may not be affordable to me where my kids go to school, but I may still stretch and buy. Investment, most likely not. So my definitions change. Transport, important, that I need to be able to go to the office and I need to come back to my family at all point of time. But investment, that's not so much of an importance, because somebody else will stay there. Somebody else who has their objective there will stay there. I should be able to have a low vacancy rate. So everybody wants to stay there. That's it. People should want to stay there. That's important to me. I don't want to stay there. That's why I'm having an investment property, or I'm just investing for some other reasons. Markets, that there's a cause or a volley or something or the other nearby to me, and that thing where I can go and get my stuff easy. That family bit is more important where I want to live in. But when I want to invest, I want to see what's the demand and supply in that suburb. Is the demand and supply of that suburb skewed towards more and more people demanding to buy in that area? I'm going to have a capital growth, right? That's what I want. So that's where the factors change. My definition changes. Socio-economy, mostly similar for both kind of cases. What kind of people live there or rent there, and that's how I'm going to get a higher rent or a lower rent or any of these objectives. Then very critical, when I want to live in, I want to see where my family and friends stay. But when I don't want to live in there, what I want to see is the infrastructure, so that somebody else whose family or friends stay in that neighborhood would want to stay there and are going to be gainfully employed. So the definitions and the way people look at it when they're looking at a suburb will completely change, whether you're looking at an investment or you're looking at to stay into it. And that's where that's where the whole thing about suburbs definition starts changing. Let's have a very quick understanding of what's the impact of these things. Very clear. The first parameter that drives capital growth, right? Similarly, the second parameter, when we're looking at transport or low vacancy rate, what is that driving? Low vacancy rate means that my house is never going to be vacant. I will have a great cash flow coming into that property. Very again similar thing, when it's a high demand low supply area, what I'm looking at is again a high capital growth, because it's in high demand, so more and more people will want to buy there. Very likely that the price of that area changes and increases, and people are wanting to increase buy more there, and that's where the capital growth gets impacted from that suburb. Similarly, if the social economy, when the kind of people who stay in that area again drives capital growth, and we'll have Julius talk about these things in more detail in the when he takes forward the presentation. But that's the impact of a socio economy on a suburb. The capital growth is what gets driven from there, because better the suburb, more chances that people will want to buy there, and hence more chances the property prices will rise. Similarly, an infrastructure or a population growth of my friends and family staying there, again, I want to buy there. There is an area where the lot of setup is happening, because it's happening, so capital growth is a very likely outcome out of it. When all of these parameters are there, what happens? So every suburb which defines by all these parameters, is it that good for me? Is my good the same as Julius's good, or my good and Julius's good are different? That's important, right? There is a suburb. Let's talk of a suburb in Sydney. I live in Sydney, so there is a suburb, Kellyville. Is that Kellyville good for me and Julius both the same or not? It's a good suburb. A lot of people want to live there, but is it good for me? Let's see. What kind of suburbs, what kind of definitions of suburbs are there for various people in all these years? What we've seen, maybe we've categorized them into four, maybe easier, the four top ones which are there. I want a high capital growth, but I can afford about say $1,000 negative cash flow. So what's my objective? My objective is I want a high capital growth, but I can afford $1,000 negative cash flow. Or second objective can be I want a high capital growth, but I cannot afford negative cash flow. So I want a high capital growth, but no negative cash flow. I'm kind of I don't have money to give away from my lifestyle. Or don't bother about capital growth, cash flow, all these things. Don't. I just want to have it very simple. I want the property to pay for itself. That's another type of definition. That's my definition. I want the property to pay for itself. I am not really very keen that it should grow at a particular pace or not. I am not very keen whether it is a positive, negative, all that. Wherever it grows, that's fine, but it should pay for itself the way it is right now. Or last bit, another very important bit which people ask us. I want to save tax. Don't worry about cash flow. So it can be 2.5, 3,000, 4,000 negative. I don't mind, but I want to save tax. More negative, more tax I save. So I am happy. Now, various components of tax saving and all that is, we are not getting into that. But these are some of the questions which people say, and the number one pointer on this one can be good for you, may not be good for me. So let's look at examples on this. Okay, let's look at examples on this. Why these differ? So because they differ because you and me are different, right? Kellyville, I just spoke about Kellyville. So great suburb in Sydney. If anybody knows this, it's a suburb with about 1.9 million-ish as a median price sitting in there. It has more than 85% owner occupiers staying in that suburb. What's the price range? Median price range has been going on up quite fast in all these years. It's got a 55% price increase in the last 5 years. Rent increase 36%. What it means is there is a difference, there's a lag in the rental growth in that suburb. What it's done is, because of that lag, my rental yield is sitting at 2.5% there. 2.5% when investment rates are 5.5%. So I'm 3% negative there if I am an investor. 3% negative on a $2 million price is quite a lot of money. Not everyone can afford this. So this is a high capital growth area. You can see the price growth that's happened, but it's giving you a low rental yield, a low cash flow. Maybe I'm the fourth point, the kind of category which we talked about in the last slide. That's where it may or may not fit. Again, good suburb. Regional NSW, Albury, quite very popular with investors today. Now look at the growth here in Albury. Last 5 years, 73% growth. Phenomenal. Pretty good. That's a very, very good growth in last 5 years. So you're talking of 14% per year growth, annual growth. So 53% rent rise has happened. So rental degrowth, basically the lag of rents is about 12%. That means it has now got a rental yield sitting just a shade below 4%. 4% on a 5.5% rate of interest. So I am practically sitting at about something which we spoke on the first sentence, that I'm okay for a good capital growth, but and I can only be $1,000 negative. So an Albury fits with me, but Kellyville doesn't fit with me because Kellyville is not $1,000 negative. Kellyville was some $5,000-6,000 negative. So I'm not, that's not my cup of tea. This is for someone who wants higher capital growth, but they want decent rental yield as well. So median cash flow kind of a property. Bertram, let's pick up a WA location. WA has been in talks for quite some time in all these years. So in WA we have a similar thing. It's again an owner occupier, so about 73% owner occupiers stay there. Phenomenal growth in the last 5 years, right? 123% growth in the last 5 years, 93% rental yield growth. Despite this phenomenal property growth and rental yield growth, we still have a degrowth or a lag of about 11% in the rent, but still sitting at a 5% rental yield. 5% rental yield at a 5.5% rate of interest, you are not too far off. You may be below $1,000 negative. Phenomenal cash flow, phenomenal capital growth, the kind of area with location which we may want to invest in, considering that I'm getting everything in there. So that may be something which there's a median second or the third pointer was there about what kind of suburb. Maybe this suburb suits me, where I'm getting everything and I'm happy with that suburb. Let's look at Victoria, one suburb in Victoria, Craigieburn, all right? Now, Craigieburn, again, 80%, 79, 80% of people are owner-occupiers there. It's seen a yo-yo. Victoria has been a laggard in the last few years. 23% rental rise, a property rise, but a different thing happened there. Okay, rentals were so low in Victoria that rental rise is more than the property price rise, which very surprising, and that's only in Victoria because of reasons. Let's not get into the reasons right now. That's not the part of it. So 37% rental increase has happened, which means overall it's not a lag, it's a lead, which rental growth has happened there, and the rental yield is sitting at 4.5%, which is pretty good. It's a gross rental yield. Net rental yield I'm not getting into. Victoria has a lower net rental yield because of land tax and all the other issues, but let's not go there. So this is for someone who wants a median cash flow and good rental yield. So overall, if I try and summarize what we've been talking, a good suburb will have something which suits me. How does it suit me? It suits my income, my circumstances. My income says that I can afford to pay $1,000, or I can afford to pay $1,200 or something, or $1,500 or something. My income is saying that. My objectives are that I don't want to spend more than $1,000 from my cash flow. Suits me. Or my preferences are, what my preferences would be. My preference is that I want a house which wants to pay for itself. Or my preference is I want a 4 bedroom, 3 bedroom, 3 bathroom, 2 bathroom, all those combinations. Or I want a townhouse, or I want a suburb which is near water. So my preference is all controllable activities, which is my definition of a good suburb. But what I can't control, which is where the suburb issue becomes a bit critical, which is where we start looking at getting help from other people and from experts or from various people who understand this bit is that what's happening to the market conditions. Now, Victoria, a Craigieburn looks 4.5%, looks very good. But is it a good suburb for me for investing into the long term? Bertram looks very good. Why should not everybody buy in Bertram? But is it suiting me, and why? There are external conditions, external things which may or may not suit and match with what I want to achieve, and hence my definition of a good suburb differs from your definition of a good suburb, and will all keep on differing between you and me because we are looking at everything with a different eye. And when we are looking at everything with a different eye, it becomes important that we understand how we are able to decide and what we are able to do to be able to find the suburb where I want to invest. And that's where we would need people to be able to help us and to be able to tell us on what do we do, how do I do a data analysis so that I find that suburb which is good as per me, right? And to find that good suburb which is as per me, find that fourth quadrant of a property where I want to find, and that fits in the jigsaw about my property portfolio. I would need to be able to analyze data, and I would need to be able to sort out that last external bit in the whole four bits which we spoke about in the last slide. And who better than Julius who can tell us more about how we can find out a great suburb to invest. In the meanwhile, while Julius starts off, just keep on typing in your questions in your Q&A or the chat section, guys, and we'll take them at the end. But here is Julius. Maybe Julius can tell us a bit more about how do we find out a great suburb to invest.
Thank you, Parag, for an insightful session. Good evening, everyone. Let's discuss about how we can utilize the data, or with the help of the data, we can analyze a suburb which will become $1 million suburb in future. So let's start. For Give me a second. Okay, for every investor, as Parag said, for before you start investing into the property market, the strategy is very important. Why strategy is important? Because everybody has their own financial goals. Everyone's financials are different, objectives are different, and then outcome of that objective as well as how much you can invest with respect how much you can make from your entire objective and how big portfolio you can make, that is solely depends on the financials. But before we get into the financial, or when we define the objective, then to meet those objectives, we build the strategy. And we start buying the property to achieve those the objective with the help of the strategy. So that is the plan. So when we sit with the investor, we look at the objective. Few people's objective would be they want to retire early. There are a lot of investors who would like to repay their mortgage faster. And according to that, we start buying them a property. So when we look for the property, right, for every investor, either you are start of your journey or you'll be in the mid of the journey, or probably you'll be a pro investor and buying a 15th property. Always there is one question in mind that whether wherever I'm investing now, whether that suburb will have a good capital growth in future, how much would be my good rental assessment or rental income, why that suburb will grow, and what kind of tenant should I expect, how the socioeconomic changes will impact onto that suburb. So there are a lot of questions because there are more than 15,000 suburbs across Australia. And then when you look at the data, so there are more than 100 data points, out of which there are 40 critical data points, which can really impact in either way during the time of the boom cycle. So for an example, days on market is a metric which we use, a simple metric which we use to analyze how is the pressure into the market. But that metric can have a different weightage when you are at the bottom of the market, mid of the boom cycle, or the peak of the boom cycle. So how to analyze those markets, which metric will have a more weightage or correct amount of weightage when which kind of market cycle timing you are in, and then how to find out, that is a very complicated question, because a wrong assessment of the data will give you a very bad output, and then you'll end up investing into the very bad suburb, where either the suburb will be at the peak of the performance, and then you're investing into the suburb where the investors ratio is extremely higher, You would have invested heavily into that suburb. A lot of investors, you are at the peak, and then for next 6, 7 to 8 years, probably you'll not find a good growth in that suburb. Or if you analyze the data correctly, if you have that mindset of analysis, and then if it is a very good analysis, you can end up getting a suburb where you are early into the cycle, and then you can enjoy the entire boom cycle in 3 to 4 years, which will make your money in multifold. So that is very important, how to analyze the data. And then that's very complex query, because there are a lot of data points. So to resolve this complex query, we build our own product called Propel Next. Propel Next is a combination of multiple metrics, because currently there are a lot of tools available in the market which are solely depend on demand and supply indicator. So wherever the demand is on the higher side and the supply is lower, that rule of mathematics that basically the property prices will go up. But whether those property prices will go up for a long-term basis, or it's a momentarily dip or momentarily spur into the property prices, whether those property increments are sustainable growth, that there are so many questions. That's why demand and supply is not the single measure which we have to use to understand whether the property market will boom or it is going to be sustainable boom. So that's why we define a algorithm in a such a way that basically we get a demand and supply indicator related fundamentals. We work on a fundamental analysis like affordability, incomes, population growth, infrastructure projects. And when our score changes, my score is not only depend on demand and supply. So all this parameter with demand and supply as well as the fundamental has equal weightage. So when the score changes, that means all these parameters are taken into the consideration, and higher the score is better the capital growth. So the first metric is demand and supply. So on demand side, sorry. Yeah. So from supply side, we look at the stock on market. Stock on market is very important parameter. So for an example, if you have 1,000 properties in a particular suburb, out of which 100 properties on the sale, that means it's 10% stock on market. And that is bad. So that means we have thresholds created for every metric. So if the stock on market is below a threshold, that means yes, supply shrinking, and then we have to measure the demand. Second is basically inventory. Inventory means amount of supply which is piled up by the month. So for an example, one suburb's absorption rate is around 50 properties a month. And for an example, if we have 500 properties still lying into the market, then it's around 10 months worth of inventory still remaining. That means if suppose if the stock on market is pretty low, but still if there is heaps of inventory which is lying into the market, unless that inventory is completely shrinked or absorbed, your property prices will not move, because they still inventory available into the market. Even the supply is not great, the incoming supply is not great, but still there is a piled up of supply which has to be diminished. So the inventory is very important parameter. Third is the building approvals. Building approval is very important. Building approval can't be measured in a days. So basically, when you look at the building approval, we look at the historical building approval rate as well as what are the future building approvals. That will say, if suppose the supply is if the stock on market is low, inventory is pretty low, overall supply parameters are extremely low. But if suppose there is a lot of greenfield development, and then if it is releasing a lot of lots into the market, then it can give you a lot of building approvals. If suppose suddenly if there are a lot of infusion of the houses into the market, then it can boost up supply by a few percentage, and then rather than higher demand and lower supply, it will be neutralized, and then your property prices will not move. But in building approval, we also look for, okay, what kind of properties are they coming up, who are more interested, whether the owner occupiers or the investors. If the absorption rate of the building approvals are more than 90% with there are heaps of owner occupier, we are buying those properties, that means it's good for that suburb, and then you'll have a good property growth, group property price growth, because of the fact that fundamentally a lot of owner occupiers are moving there because of the fundamental parameters. So that is very important parameter to measure. We also look at the hold period. Hold period is very important parameter. There are a lot of tendencies that investors comes, they just be into that market for a few years, and as soon as the suburb performance is okay, they start selling those properties. That means they are like, if the hold period is 2 to 3 years, that is not good for the suburb. In a case if hold period is 7 to 8 years, that means a lot of people are living into that suburb because of the fundamental. The characteristics of that suburbs are very good, and then they are aligning with the owner occupies requirement. So that suburb will have a long-term growth. So that's why hold periods are very important. We check that into the system. From the demand side, we look at the affordability. Affordability is very, very important parameter. For an example, demand and supply has a lot of gap. But for an example, there'll be time that demand exceeds supply. You have a lot of investors coming up into that market, and the investors are very much cash flow sensitive. The moment the rental yields goes below 4%, then the investors will start vacating from that market. And then if suppose the owner occupier were living there, if the incomes versus affordability is not great, then property prices will have a long-term stagnancy. That's why buying affordability within the owner occupier and the renting affordability, which is very important parameter too, because if there are a lot of supply issues and high demand, and if within the renters, if there is a good amount of renting affordability because of their income, then you will have rental rises. Rental rises will give you a good yields, which will attract more investors, and then it will create more demand in where the supply is lower, and then you'll have a good property price growth. So that's why renting affordability and buying affordability are extremely important parameter. So we look at that. We also look at the demographic changes. Demographic changes means basically socioeconomic changes. They're very important because it's not a 1 year process. So we take data from the multiple censuses to understand over the period of 3 censuses, how much the CFA index of that entire area has been changed. CFA index is the benchmark which has been defined by ABS. It is a ranking from 1 to 10. 1 means extremely poor versus 10 means extremely good. So if suppose for the area where the CFA index has been changing from 1 to 3 or 3 to 5, that means the socioeconomic outlay of that entire area changing, and that will increase the more affordability within that area. And if suppose the supply is lower and the demand is on the higher side, then because of the demographic changes, more amount of good population who is moving there have a highest affordability, and you'll have a good population growth. So that's why demographic changes tracking is very important. We also look at auction clearance rate. Auction clearance rate is a short-term parameter where if the auction clearance rate higher means basically there is more amount of demand which is created, percent sale growth is extremely higher, so sales turnover is higher. That means basically the properties are selling faster, and that means so the more demand is being created, and then if there is supply shortage, then you'll have a property price growth. The last parameter in the demand and supply indicator is basically rental turnover. Higher the rental turnover means extremely lower vacancy, and if you are renting affordability, that means you'll have a rental rise, which is directly proportionate to your property price rise. So that parameter is very important. So next metric is the demographic changes. So we look at the population growth. Population growth is very important parameter. In terms of the population growth, we look at what kind of population is moving in that area. So for an example, entire council's population growth is above state average. Then we look at, okay, whether the retirees are moving there or young families are moving there. That's very important. So if the population growth is on the higher side with the young families, if there is a lower supply, it is creating more demand into that particular area. And if there is a high affordability, that means you'll have a property price rise. So the property price has a linear proportion with the population growth. So that is very important parameter. We also look at the immigration number. Immigration, we have two sets where we look at the external overseas immigration versus the net internal migration. If external overseas immigrations is higher on that particular state or council or the suburb, that means it creates more pressure on the rental side, because when immigrants come, they first go for the renting. If it creates more rental demand, then it increases the rental prices. That is directly related to the property prices. So that's why immigration tracking is very important. We check that into the system. Then the median income are directly proportionate to the related towards the affordability, buying affordability and the renting affordability. If the median incomes are increasing, and if you look at future trends for the median income, they are into the increasing manner, then it has direct impact on to the buying affordability and to the renting affordability. And so that's why median income are very important. So we check that into the system as well. the last parameter in that particular matrix is basically a socioeconomic index that is called as a CFA index. If CFA index are changing from census to census, then it's good and it has direct impact onto the property price rise. So we check that. Then the last one is a gentrification. Gentrification is a long due process. It is directly related to the socioeconomic index. If the socioeconomic index is changing, that means area is gentrifying. If area is gentrifying, that means good income earners are moving into that area, which is increasing the buying affordability and the renting affordability, and it has direct impact on the property prices. The next main matrix is basically the economical indicators. So in that, the first submatrix is the job opportunities. Job opportunities are very important, but within the job opportunity, we look at employment diversity. So for an example, in an entire region, there are a lot of jobs is being created by the mining or the solar project, which can be a temporary project. Or if the entire region is been driving by one single employment, then that is not good as well. So that's why diversification of the employment is very important. In our system, we have configured that called as jobs categorization risk. Wherever the job concentration risk is higher than certain thresholds, we flag that area, and then we have to do the further assessment whether that area will be good for the long-term investment or not. So that's why employment diversification is very important parameter, and that is already been taken care into the system. The third one is basically socioeconomic indicators, hospital, school, shopping, and amenities infrastructure. If that infrastructure is heavily created, that means that is to serve the more population growth. So that has a direct impact onto the property prices. So we check that as well. Um, the next one is the affluency score. That is what we've talked about. That is for the entire region as well as the suburb. Because when we look at the suburb, then there are suburbs within the suburb where we look at the small subset of the suburb called the CFA index. So when you look at the statistical area one, then we check the CFA index of that particular statistical area one, because in one entire suburb, you'll have a multiple SA1s. SA2 means suburb, SA1 means basically a subset of the suburb. So you could see a property price difference between the two different pockets of the suburb. So one SA1 would be probably, it would be the ranking of 3 of CFA index versus the other one will be around 6. So to measure the difference, that affluence score measure within those SA1s are very important. And then we have configured that in our own internal maps. The next indicator is new and existing infrastructure creations. New and existing infrastructure creation is very important. For example, if there's a lot of new infrastructure creation happening, we measure, okay, basically, is it to serve the current population or the to cater the new population? If it is to serve the new population, that means there is a projection of the good population growth in the entire area, and which is giving you good signals about, yes, property prices are going to be rise because affordability is going to increase, more demand is going to be created for the houses and all the stuff. We also track the transportation and the power infrastructure. If that infrastructure is improving, that means more job opportunities are going to be created in the entire region. So we track that. We also look at the rezoning changes. If, as per the strategy, if you have to buy properties where you can subdivide the land or you would like to hold the land to manufacture the equity, then the zoning changes are very important. Like in Perth, basically, if you go towards the inner CBD like coastal councils, a lot of properties we are buying on the bigger land where because the entire council is going through the major rezoning, and then zoning is been changing from R17.5 to R30 and R60. Similarly, in Adelaide, when you go towards the Playford Council, we are not just buying the properties because of the houses, we are buying for the land because the entire area is rezoning, and then the zoning has been changed from general neighborhood to the master plan neighborhood. That's why the tracking of the rezoning is very important, and we track the data. So this is a backend snapshot of our database. So basically, when you look at the first screenshot, this is the REDA. REDA means basically a filtration system where SA3 means statistical area 3. So we look at the council first before we get into the suburbs. So because council has a bigger boundaries, and then bigger boundary means statistical reliability of data is extremely good. So with the council, we look at the 10 years price change, which is historical growth, which shows, okay, Historically, area was going good, then it has a good fundamental, which gives us the confidence to move further. And we look for the current demand and supply indicator. So we look at the 1 month and 3 month price change with the inventory. If the inventory is shrinking, then we look at the inventory trends. Probably currently, if the inventory score is definitely good, but for an example, the trends are bad, that means more amount of properties are going to be into the market, and that is not good for the growth. So we have a trending engine as well. We also look at the inventory forecasting, days on market forecasting. We check the buying and the renting affordability of that particular suburb. The next tab within our database is basically a population related. So infuse a lot of data from the multiple censuses to understand what kind of population group is happening, what kind of population growth is there, family sample size, and then age groups. We also look at the job by category. So this is a job concentration risk. Wherever the job concentration risk is more than 20% in a single employment in a major industry, then that's a risk, and that's why our score highlights that. So that is also configured into the system. So with the what did we achieve with the Propel Next? So around till last year, there were a lot of investors were buying towards the regional. Sorry, investors were buying towards the Victoria or the regional Queensland. Uh, so people were overpaying over there. There is a big campaign which has been created to inflate the prices. Investor proportion is extremely higher, more than 50%. And when you look at the actual rental proportions are more than 50%, by then we have found out that regional NSW has a lot of scope. So we've started buying properties in regional NSW. We found out that okay, WA will come up again, and we have started investing in the WA again. And so far now, if you see the Perth market, from last 6 months, the property prices have risen by around 8 to 9%. Since last year, when we were buying into the regional NSW, our returns are around 17 to 18%. So that's the beauty of the Propel Next. So what are the next location which we can look at? So when we look at the location, right, location specified by the councils, and then we picked up a location within that councils. So it doesn't mean that you have to only look at one location, but you can focus on the council as well. The first location is from the South Australia, is Lindok is from Barossa Valley. It's a good council. There are multiple suburbs within that councils. But when we do the filtration of the suburb, we have taken care of affluency score. That is very important because now demand and supply will not make a lot of impact. Now we have to look for fundamental growth. So that's why socioeconomic changes are very important. So that's why when I filter the systems suburbs, we have added certain filtration criteria where we have added affluency, affordability, demand and supply, and employment diversification. And then according to the weightage, our score is 84. So when you look at the affordability in that suburb is extremely good, which is 89. It's a nice affluent suburb, mid socio 6 out of 10, which is not bad. It's extremely good. Demand and supply has a lot of gap at this stage, and employment diversification is extremely good. So risk is very low. So overall score is 84 out of 100, which is pretty good. So that's a good suburb to look at. But yes, rather than looking at the suburb, look at the entire council, and you can make your hypothesis around it. So next location is in Lower Hunter in NSW. There is a location called Singleton. So affordability wise, Singleton is at 85 score, extremely good. It's a good affluent location where the incomes are very high. That's why we have selected this suburb, because we are looking at the fundamental investment. Good affluent location, demand and supply has good gap. It is generating now because that area is getting into the good boom cycle. Employment diversification is good. Overall score is 73, which has been changed from 68 from last 2 months of data. So that suburb is getting into the boom cycle now. The next location is in the Bunbury. So when you look at the Bunbury, Bunbury is a council extremely south of the Rockingham and south of the Perth. So Bunbury Council has a lot of infrastructure projects, and there are a lot of suburbs which are already booming. So we have selected specifically Capel because in Bunbury, there are a lot of suburbs which are either very expensive or there are suburbs which are a little bit expensive, but they are extremely low socio. Capel is a suburb where the affordability is very good because of the incomes. And then affluence is still at 50, which has been changed from 30 to 50 from last 2 censuses. So that's why that means the suburb is actually gentrifying. At this stage, the property prices are not at the stage where it's supposed to be. That means there is enough gap to fill. So that is called as the gap analysis as per a system. Demand and supply has a lot of gap, extremely hot location. Employment diversification risk is low. Overall score is 82. Next location is Kumbuya in Toowoomba. So we all know that Toowoomba is a significant urban area very close to the Brisbane. It has a good population growth. Significant. If you look at the property prices in Toowoomba, in a lot of places where they have grown up significantly, they are in 800 to 900 range. So especially for the Toowoomba, when I was looking for the property prices between 500 to $700,000 with the affordable range, and where there is enough demand is being created by an investor and the owner occupier, then Kumbaya all makes all the ticks. So basically, affordability is good. It's good affluence above with the affluence score of 50. Demand and supply has extremely high gap. Employment diversification is good. Score is 79, which has been changed from, I believe, 74 from last few data sets. So that's a good location to focus on. And then last council is there's location called Kinross. So if someone is looking for higher budget properties with the very high capital growth with around 4.5 to 5.2% rental yield in a good capital city where the budgets are in between 900 and 1.1 million, then that's a suburb which look for. Part of the Jindalop, we all know that Jindalop is extremely expensive council with a lot of infrastructure project. Affordability wise, incomes are around $3,200, which is extremely higher. Affordability score is very good. Affluency, if you look at the surrounding suburbs, all the suburbs are extremely high affluent, which are ranging in between 1.3 to 1.4 million, and their socioeconomic is around 90. That means this suburb has a lot of potential for the ripple effect. So demand and supply has extremely high gap. Employment diversification is pretty good. An overall score is 86. That means this suburb has a lot to catch up from the neighbors. So neighborhood price balancing will be extremely higher with the ripple effect. So that's a good suburb if you want to spend in between $1 million. So when you are looking for any property in your portfolio, just don't look at data, don't hear something on the televisions or the Google, don't follow just random advice. Look at the data in not only demand and supply manner, but in like the demand and supply fundamentals, study the data sets and take an informed decision. From here, I would like to hand over to Parag.
Thank you so much, Julius. Thank you very much. It's so interesting to hear from you, and so interesting to hear the kind of parameters which come into play whenever somebody is wanting to see a property. When you're looking at trying to find a property, and we're looking at investing somewhere, there are so many parameters which come in, and that's where the choice of a suburb. That's where why we want to create a suburb becomes so critical. That because that defines how we are going to go ahead and able to invest into some other area, and how do I find the suburb which is there. That all these parameters put together, if I am able to control them and if I am able to read them and understand to whatever limited resources we can get our hands into, it makes it worthwhile for us to be able to invest. We've done that for quite some time. In fact, what are with for all these years with the clients who've been working with us at their various forums. So it's just an example about us that we've been able to give them a quite a bit of an ongoing support, and something which we work through a goal-based activity for everyone, that whatever your goals are, like we said, those are four examples which we spoke about of objectives for various people. So whatever is the objective, how does a particular suburb fit into that? And that's because of that you will find that there has been quite a bit of feedback which we've got. A lot of them is positive, and most of them is positive, and you can see us on Google and all that, and some of the gist of what people spoke is there with us. But I'll not come in between you and your queries. I know there are heaps of queries which are there waiting for us to be able to explain that to you, or to take your queries now. So I'll, without wasting any more of your time, Julius, let's go ahead and take all the questions. Is that okay with you?
Yeah, we can start now.
All right, so I'll first look at the chat questions, and then I'll look at the other the Q&A questions. People have put in questions wherever they could, and that's all good. Uh, all right. The first one, that's your fireflies. Do you have market analysis for reverse turn NSW for investors?
Yeah, we do have. So it's all depends on what are the objectives. So basically, when we look at the property investment, we look at two things: capital growth versus the rental yields. For an example, we can buy in Sydney with the 3% rental yield, and then out of pocket expenses will be very close to
Yeah.
$2,000 to $3,000 a month. Versus if you are in higher tax bracket, still your net loss is around $20,000. So if you accumulate that loss of $20,000 over the 10 years, probably around $200,000 versus the amount of capital growth which you're going to achieve into that particular area. If you divide that risk and buy properties where you can have a similar compound annual growth of around 7 to 8% in different council or suburbs with around 5% rental yield, then it will impact your borrowing capacity in the positive manner, as well as your risk to getting into a single property where it can go either way. And then if the assessment is not correctly, or if there is a major impact into the market, then you will only have one property which is on the higher risk rather than you can divide your risk. Especially when you look at the Riverston, right? Riverston still has little bit of land supply coming up. But yes, it's not, but it's still the moderate land supply. Socioeconomy wise, it's improving. So if I look at the socioeconomic score of the Riverston or wherever the new supply which is coming up, because a lot of IT professionals, accountants, and a lot of professionals are moving there. So basically, the socioeconomy changes in certain pockets of the Riverstons are around in between 6 and 7, versus there are a lot of pockets in Riverstons are in between 2 and 3. So few pockets are low socioeconomic as well. Riverston as a suburb have increased a lot of price gain from last 3 to 4 years. So that means at this stage, Riverston is exactly sitting at the verge of the affordability where property prices have gone up significantly. Unless there will be a significant interest rate drops in the market, then the chances of having that capital growth in next 3 to 4 years will be extremely minimal. So if you look at our score for the Riverstone is around 62, which is not great. The score above 70 is starting where the markets are starting from warm to hot. 62 means extremely cold. So at this stage, it's not a great market to invest.
That's so right. No, in fact, and we were speaking about when we were talking during the presentation, we were speaking about what locations suit you or what locations don't suit you. Riverstone is definitely a it's an owner-occupier suburb. A lot of owner-occupiers want to live there, who want to build a newer house and want to stay in that. So, as an investor, you need to really weigh in what you want to do when you want to invest in Riverstone, and what are your objectives are. And when, as I said, with being a boundaryless investor, if you think that for the same money which you are investing into it, whether Riverstone will give you a better return or some other suburb, some other town is going to give you a better return on the same money invested, it's your call on how you would want to weigh that out. Okay, I'll go move on. We have a lot of ground to cover. We all want maximum capital growth, but challenge is knowing where the growth will happen, as past years may not tell correctly. That's right, Rakesh. It's a very good observation. And see, understand, we have to all understand that nobody has a crystal ball. Nobody has a if I could forecast, and if I could foretell, or if I could tell that this is the suburb which is going to give you 100%, everybody will be there, right? Well, I will also be there. Why not? So, but unfortunately, that's not there. So we don't work on prediction. We all work on probabilities. There is a difference between prediction and probabilities. Prediction comes with a crystal ball where you're saying, okay, I predict this is going to happen. I predict the World Cup will be won by an X team. But probabilities is what, say, talks about performances, past data, trend analysis, and then saying, okay, with these kind of trends and these kind of analysis, such a suburb has done very well, and the X suburb which is in the question mirrors these kind of conditions of that suburb which did well. Hence, the probability of this suburb growing faster is high. It's not 100%, it's high. And that is what we have to understand, that nobody can predict. If we could predict, it's a different thing. We can only go and say probability wise which one looks better. And then obviously it's an intelligent call which everybody has to take. I'll move on. How about investing very little amount in house and land releases and selling it on completion in case you don't have very big amount for investment? I'll answer this, Julius. So I've seen in all these years, and as a mortgage broker, I'll give you my bit on this. I've seen a lot of guys who would want to buy a land and think that I'll sell it when it comes for registration or after registration, or I'll sell it later, or I'll construct a house and sell it later, and do all that. Quite a few risks there, and especially when you're low on cash. There are valuation issues which can come in. There is, at the time of registration, your economic situation may be different, your circumstance may be different, you may or may not get a loan. A lot of stuff happens when you're buying something for the future. But if nothing of this sort happens in the future, and if you're able to buy in a great suburb, which is whether it's a house and land or an existing property, and you think that it fits with your objectives, why not? Investment is, there are heaps and heaps and heaps of methods of investment. Not every investment suits everyone. Not every investment is going to be good, and not every investment is going to be bad. Okay, I'll move to the Q&A question. I'll keep on jumping here and there, guys. So to start, just so that everybody tries and gets an option of doing it. And we normally, I know we are running short of time, but we'll extend our session to so that we cover the maximum questions as we can. Okay, can I get a loan against equity from my PPOR and get the money in my bank account before winning any auction for the investment property and use the loan money for the 10% deposit in the day of auction and rest of the money for stamp duty at the time of settlement, still claiming the tax deduction on the interest paid on the entire loan amount? All right, yeah, they're correct. So that's a very typical structure which is followed when we are looking at having somebody invest into it, that you get an equity against the PPR or any other investment property which somebody has. You can do it in two ways. You can do a simultaneous settlement. If you don't have money, you can take the equity earlier, and then you are able to get an 80, 90, whatever percent on the property which you have bought. Typically, all these loans, whenever you look at claiming a tax benefit on these loans which you're taking, it is the objective of the loan which becomes important. So if your objective of the equity which you've taken out was investment, and you do the investment very soon, then you are able to claim everything on tax deduction. Okay, next question, and I can, if you're not clear on this, you can always reach out. I can explain that to you. It's a very typical structure which is used, but you will be able to claim tax benefit on this for sure. Best rate of interest with 90% LVR and LMI also included in the loan. Very specific question. Depends on the loan amounts, depends on lenders. You can get rates from 5.8% interest only till at 90% LVR till 6.5% as well. But again, not what good is a rate of interest if you can't get the loan which you want. So it all depends on borrowing capacity and the rate of interest combination. Okay, so let's switch to the chat questions. One more question. By looking into flooding zone for 18, there's a particular address. Google Earth gave me an elevation of 30 meters, and by looking into the Blacktown map, it says mainstream flooding none. Bit confused. Is it safe to buy this property? Mate, we normally don't want to discuss personal and individual related questions here. With all honesty and with all everything, we would love to answer a question. No obligation, just reach out to us directly tomorrow and we'll give you an update on the property which you're looking at. But this property may belong to somebody else at this stage, and we don't want to discuss somebody's personal circumstances here. But yeah, I understand your question, and my numbers are there. Julius's numbers are there. Give us a call and we'll give you an update on this property for sure tomorrow. Can you please share the Excel? Julius, you want to answer that?
At this stage, it's we can't do that because it is something which is in-house research, and there are a lot of copyrights. So basically, yes, if you want to book a session with us, probably we can answer your questions in depth. If you have any queries about any suburbs, or I post a lot of data on social media. So if you follow Propwell, if you follow a few Facebook groups or follow our profiles, my and Parag's profile, you could see exactly what kind of suburb we are talking about, what are the top 10 suburbs. According to your strategy, if those meet you, your requirement, then definitely you can pick up suburb from there. But sharing this Excel sheet at this stage, no.
See, please understand, my friend, that this is a lot of research which goes into this, and research is always proprietary. You are more than welcome to come and see and judge for yourself. Also, yeah, I can tell you this, that I think in about within the next 30 days, before end of November, you will find that in fact a part of the screen is available there. You will find a suburb analysis kind of a report you can download from PropWealth Next. Basically, from our PropWealth website, there will be a tab called PropWealth Next where you will be able to do that. But to share the full data with you will be a bit tough. Okay, next question. So some show the growth cycles where it suggests Victoria is best. Your views on this, Julius?
Yeah, so we are not saying that Victoria will not be getting into the growth cycle. Yes, there are few pockets of Victoria already going. So Victoria as a state, if you look at the regional Victoria, Wodonga is growing for a while. Like we are investing there from a year now. Bendigo is doing good. Shepparton is extremely doing good. Few pockets of Geelong are doing good. When we talk about the Victoria, where people are confused about Victoria as well as the Melbourne. In Melbourne, there are few pockets which are doing extremely good, because especially towards the southeast or inner CBD suburbs. But there are a lot of suburbs where the supply indicators are extremely higher. So for an example, if you compare the property prices between Melbourne and Sydney from 2018, so let's divide this into land prices versus the construction prices. In 2018, Sydney's property prices, so land prices towards the northwest section was around $1,000 to $1,200 per square meter. They've reached up to $3,200 per square meter by 2025. That means your land prices are going to be tripled from last 70 years, and that's how the property prices are growing. So property prices are doubled because the land prices are growing exceptionally higher rather than the construction prices. When you're focusing towards the Melbourne, there are few pockets towards the northern or the extremely western side. Because of the extremely higher availability of the land plus the contour is flat, it's a greenfield development. So land development is extremely cheaper, plus the availability of the land is extremely higher. So from 2018 till 2025, the land prices have changed marginally. That means they were around 700, they were around $500 to $550 per square meter. Now they're at around $800 per square meter. So that is very minor jump. That's why the property prices in the Melbourne are not growing. It's just not because it's cheap because of the reason. So if you avoid few pockets of the Melbourne where you are seeing extremely high supply, like Craigieburn, between the Craigieburn, Beveridge and the Wallen, there are going to be 3 new precincts coming up, which is in next 10 years will be around 15,000 new lots will be introduced to the market. So that is like a humongous amount of supply which is coming into the market. So what I meant to say is, when you look at the Victoria versus Melbourne, don't just mix up about feeling of the Melbourne and the Victoria. Yes, there are a lot of good pockets in Victoria where we are investing, and then the property prices are growing significantly higher, like Wodonga, Shepparton, Bendigo, Geelong, and pockets of Melbourne. So yes, Victoria, few pockets of the Victoria and few pockets of the Melbourne are already in the good growth cycle, and then they expect it to be remain so for next 2 to 3 years.
Quickly, just there are a few questions I'm trying to club in. People have
Yeah.
asked about Geelong and Ballarat as well.
Yeah. So towards the Geelong, there are few pockets in the Geelong are extremely low. Like if you go towards the Norland and the Corio, so there are a lot of investments which are happening into that side of the Geelong from the investors are like they are buying very old property with the bigger land. But when we were comparing the amount of properties which are available into the market in that segment, they are around 8 to 10,000. That means, for an example, if someone's strategy is to buy that property and then later gonna subdivide, it is not going to happen because amount of properties which are available in that segment or that asset type extremely higher. So that strategy won't work in towards that Korean Norland. There are good pockets in Geelong, like when you go towards Lara or Armstrong Creek, where the supply is a little bit higher, but still the social economy is good. In long-term basis, you will see a good growth because of the extremely higher population growth, plus the good social economy. When you look at the Ballarat, they have a good pockets and the bad pockets. Similarly, when you're looking at the Ballarat and the Geelong, you're not looking at the capital growth in next 1 year, 2 years. If your strategy is to hold the asset for next 3 to 4, 5 years, then definitely you can see a capital growth. But when you're starting your journey and then you have to have a good capital growth in 1 to 2 years, so equity extraction time will be faster, then these are not the region for you. Versus there are few pockets within the Ballarat and Geelong are showing an indication of early sign of growth, but you have to be very careful if you are buying your first home in that section.
In fact, I had asked half the question, but you've answered that anyways. It was about Choreo in Geelong, so yeah,
Yeah.
you've answered that anyway. So I'll move on from this question. Uh, I'll keep on clubbing some stuff, so guys. So please don't be surprised that I didn't ask that. So it's just I'm clubbing chat and the Q&A questions. Uh, is DHA housing good to invest?
It depends on what are the requirements. So when you go with the DHA, right, there are plus and minuses. So DHA will take your house for lease of at least 5 to 10 years. It's a long lease. In between, if you have to sell the property, it will be still remain under the DHS position. So you need to find the investors who will look for that property. The property management rate for the DHA is around 16%, which is double whatever you pay in Perth and Townsville, because that's a place where you can see a lot of DHA homes. Good thing about the DH is you have a consistent rental. So for an example, if your tenant goes away, still you'll get the rental. They are gonna maintain the property. All the maintenance of the property is taken care by the DHA. When they hand over the property after the lease finished, then the little bit of cosmetic works like painting, landscaping are fully done by the DHA and they'll hand over it to you. Also, when you look at the DHA properties, the rental rises and the rental assessment is a bit different than the market assessment. So they have their own assessment system. So if you're buying a property for the long-term investment where in the case, if suppose you can hold it irrespective if there are any circumstances changes in your life, and if you have to sell this property immediately, there might be challenges, or else it's plus and minuses. So it depends on the circumstances as well as the requirement, but it's not a bad investment either.
Yeah, yeah, correct. Uh, in today's market, where yields are low and prices have already moved high, how realistic is building a portfolio of 5 to 10 investment properties, that too with BA fees for every purchase? Julius.
Yeah, can you come again? Sorry, I
Okay,
missed the question.
I'll tell you the question. So the question basically is, it's that in this today's time where prices are higher and yields are a bit lower, how realistic is building a portfolio of 5 to 10 investment properties, and considering BFEs will be there for every property?
Yeah, correct. So it depends on how smart you buy versus how you structure your finances. So for an example, if my borrowing capacity is around $1 million and if you're looking only in Melbourne, for an example, then you're going to buy one or two properties and you're going to stop your journey because of the fact that your cash flow is not managed. When you define the entire portfolio, right, there is a planning. So for an example, I'll buy a first property, or for an example, I'll split that 1 million into two properties. The first property will be $500,000, which will be like high capital growth. So equity extraction time for that property would be years to 2 years time. And if I manage to get the rental yield of around 4.7 to 5.2%, then it's not bad. That means when the interest rate will be corrected and then when they'll be at in between 4 to 4.5%, your property will be marginally neutrally geared, which is okay. And it will not impact negative on your borrowing capacity. So when you structure your portfolio, there'll be time in your portfolio when you have one or two properties, and now you have to buy a property where you have to manage the cash flow. For an example, your first two properties are either negatively geared or neutrally geared. To increase your borrowing capacity, either you can get into the trust structure where the trust will allow you to borrow more in few circumstances, and then you can have a more borrowing capacity preserved, and then you can buy more properties. But when you're buying in a trust, and there are certain limitations also. There is additional cost involved, plus you can't claim those taxes of negative gearing and depreciation. That's why if you look at the property which will be slightly towards the positively geared, then in your portfolio, you should have a few properties of high capital growth, few properties towards the moderate capital growth and the high cash flow. And then there should be a few properties where house and granny or the duplexes where the cash flow will be phenomenally high. So when you balance the cash flow within the portfolio strategically, then you can have a multiple asset placement. If you make a mistake and buy one property of $1 million in Sydney, then definitely you can't grow. If you do a mistake and buy two or three properties in Melbourne at the same time for 500 each, you can't grow. But if you try to put the properties across Australia with the good capital growth and the high cash flow, or the combination of both, then strategically you can put the assets and then you can have a good strategic portfolio.
All right. We'll sorry, Julius, we'll go a bit quick because I'm really behind on the number of questions we have
Yeah.
right now. Uh, and sorry, guys, I'll just club some more. Uh, there is a question, and there's the two questions related. So somebody's asked us, can we recommend one suburb where I can pay only $1,000 negative? And there is another, I think, similar question. I'm trying to merge it about good suburbs under 500,000 in Victoria or regional NSW or metro. So maybe something similar. Can you just answer that as well?
Yeah, so there are a lot of suburbs where we are buying in metro cities also, where the rental yields are in between 5.2 to 5.5%. It depends on the deposit you have. So for an example, if it is a first purchase and if you're paying 20% from your pocket and with the 80% lending, then probably there are a lot of suburbs in Perth as well as towards the regional NSW and pockets of Victoria where the yields are around 5.5%, especially towards the Byford or Bertram, or if you go towards the Ellenbrook, you can definitely have a property with less than $1,000 out of pocket expenses. When you look at the suburb within the $500,000 in regional side, then probably you will have few pockets remaining in Albury where if you are doing a strategic purchase or if you're able to find good property, then in Albury, Wodonga, Shepparton, you can get that type of segment. There are good properties coming up towards the western side of Tamworth. It's a little bit of low socioeconomic area, so assessment has to be done properly, but that's a suburb where you can focus. Also, if you can, there are a few good pockets like towards a little remote, like if you go towards the Scone or the Dereliquin, then that's a pocket where you can find the properties are in between 300 and 400,000. Nowadays, we are monitoring the data for the parks. It is doing phenomenally good. It's very close to the orange. And then over there, the property prices are in between 400 and 500,000 with the rental yield of very close to 5%.
All right. Now, there was another regional NSW question. I'll just merge all of these. There is a regional NSW and there is Sydney question. So we'll have Geelong, we've answered. Orange, Wellington, Dubbo. What do you think on them?
Orange, Wellington, Dubbo, all are doing good. Dubbo is extremely hot at this stage. And if you look at the data for the Dubbo is just not about demand and supply. Dubbo has a good affluency, good earnings, good infrastructure projects. Strategically, infrastructure, if you look at the infrastructure for the Dubbo, it's phenomenally, it's extremely good. So Dubbo is tracking number one, followed by Armidale and other part of the regional NSW.
All right, quick. Okay, thank you for that. Within Sydney, we're talking of owner occupied for Pendle Hill, Greystanes. Somebody asked Schofields as well, Box Hill as well. So, what do you think on them?
They all are good. It depends on your requirement because when you look at the owner occupied purchases, you look for good schools, transportation, community, and your budget. So, for an
Absolutely.
example, if you have a high deep pocket, then probably you can look for the Box Hill. It will be in between 1.5 to 2 million. It depends on the budget and the requirement. If you look at the amenity wise, and if the amenity is the key factor for you, then probably you should look at the Pendle Hill or the Greystanes. It depends, and if the transportation is the key, then Schofield is pretty good. So it depends on what kind of requirement you have, and then budget, because all these suburb mentioned have a different budget category. So Schofield and the Box Hill are in the similar category where you're going to spend in between 1.4 to 1.8 million dollars. When you look at the Pendle, it will be in between 1.2 to 1.3 million dollar. Greyston will be in between 1.2 to 1.5 million dollar.
Absolutely correct. No, in fact, I just add something here. In all these suburbs, Schofields would be maybe you will find more newer homes with smaller land. Pendle Hill and Greystanes, you'll find larger lands unless you're buying a subdivided property, but slightly older properties. But all these locations have a different flair, different combination, different reason why people buy properties. But my simple suggestion, obviously, it's not one person who's asked this, but whenever you are looking at buying a property for owner occupied purpose, first identify on why you want to buy in a particular area. Your why should precede that area, because if your why is not met and you buy an owner occupied just because you have to buy, then eventually I know people who've bought properties in, for example, Campbelltown, and they have all their friends living in Box Hill, and they would come every weekend to Box Hill, and eventually I have seen after 2 years, 3 years, they get sick of it, and then they sell the Campbelltown property and come back and start staying somewhere closer to Box Hill so that they can be next to friends and family, and so on and so forth. So owner occupied purchase has a lot of emotion into it rather than data as well. All right, okay, let's go quick. In NSW for low money home investment, we've already spoken about some locations in NSW, so I'll skip this question. Uh, we in Victoria, is Victoria a good market to invest now? Do you suggest any suburb which may perform well? My budget is 600 to 650k, so I believe Victoria is affordable in my case. Absolutely, Muthu, we've discussed a bit about Victoria already, discussed a bit about quite a bit about the locations. If you really want to know specific to your circumstances, something which pertains to you, definitely you can reach out to us. But 600 to 650, we've discussed quite a bit suburbs, and that range exists there as well. All right. Bit random. Viola Playford in South Australia and Maddington suburb in Western Australia. Two different people, different questions, but these
Yeah,
are very small regional towns if you want to quickly highlight on them.
yeah. So Playford is the council within the Adelaide metro, where if you go to, it's extremely towards the north, where in Playford Council you have Elizabeth Vale, Craigmore. Then if you look for the newer suburb like Andrews Farm, Blakeview, Munapara West, these are all the suburb. When you buy a property towards, when we discuss about the Waila versus the Playford is much better council because the zoning is changing. SA Water has a lot of limitation for the water connection now, so that's why all the properties with, so there is not more further development coming up. So all the properties already has this connection versus though in Playford Council, you can hold the property which is literally old, but it has more than 650 to 700 square meter land because the entire area is going from the zoning change. So most of the properties are changed from general neighborhood to master plan neighborhood. So that's why Playford is a much better council, even though it's a low socioeconomic area, but it's gentrifying. Most of the commission homes are moving towards Ubala. And then when you look at the Maddington is part of the Gosnells Council. It's very close to city. Maddington, the strategy to hold the properties in Maddington is basically buy a bigger amount of land because it's similar like the socioeconomy is similar like this one, Playford Council, but it's gentrifying. But the good thing is location. The location is very close to city. At this stage, the entire Gosnells Council is doing a rezoning. So a lot of properties in the Maddington are changing. Zonings are changing from R17.5 to R30. Plus, if you want to buy something into that kind of suburb, then try to buy a property with around 700 plus square meter land, 3 bedroom, 1 bathroom kind of property. You can secure that property in between 680 to 720, where the rental yields are very close to 5%.
All right, okay. I'll just add a little bit because I think I asked and half a question. So when it was asked about Viala Prayford, which is in Viala suburb, which is down south in South
Mm.
Australia, where you have the Vedant that plant which is being in question right now, which was taken over from the by the South Australia government. So it's a bit of a political thing and a lot of stuff happening there. Vela Newry, Vela Plafford, these areas were there because of the plant which was there, the steel plant which was there, which will have an impact. I knew someone and I know someone who bought a property there about 7 years ago for 130,000 dollars or something. At that kind of a price they bought a full house, and then they sold it for 160, 170. Maybe it's about 200, 250k right now, but too regional to really worry about, and too many political issues happening there as well. uh, okay, PropWealth next. Is that a specific tool like online tool we can have access to? Julius, you want to answer that,
Yeah,
or I
so
can?
it's tool made by us. It's in-house tool where we put algorithm. The subset of the proper next is going to be released soon. It's under development where the testing is already been completed. It's already in the development environment where the maps and then subset of the proper index with the report. So when you put your report suburb name, then you'll get the full report with all the scores, as well as you can go to the maps and then look at the inventory, the trends of that suburb, as well as the socioeconomic outlay. So that is going to be released into the market, some, but not the entire tool.
Yeah. For those who missed the 2020-2022 boom, is there still a chance to make it big in property market? I'll quickly answer this. Yes, obviously. See, it's not that boom has been made and that's it. Now the life is done. So it is all about, and that's where we are talking about how do we find out suburbs in areas where we can still grow, because in the end it's not about one time growth. It is also in when you are there in the property market. Therefore, if you look at a loan term, you look there for 30 years. If you're looking at your age, you'll be there for good 10, 20, 30, 40 years, or depending on how what's your age right now. So it's a very, very long term investment as a product. So it's not a miss which has happened right now. You can get a lot from the market. It's all about getting the right anchor. It's all about getting the right people around you, the right team around you. And if you are able to speak to them and if you trust them, they will definitely be able to help you out in getting into a property investment. Okay, I'll move on. I'm a first home buyer, but these many dependents, so I may get less loan. Please guide me in NSW which property is suitable, or flat, 2 BHK. I'll have to look. All right, yeah, mate, definitely. So give us a call. I'll give me a call or Julius a call. You have our numbers on the screen. We'll definitely be able to help out. It's too specific to answer right now, but yeah, what you've asked, I've understood. I've understood the entire thing, and thank you very much for raising that question. We will definitely be able to give you an advice on this. Reach out to us and don't worry on that, and we should be able to explain to you where you can buy and what you can buy, the benefits of buying an apartment or a house or land plus house, all that we'll talk about. All right. I'm interested in investing in Brisbane and would appreciate your guidance on which suburbs might offer the best growth and rental yield potential based on the parameter you discussed. Would you guide a few specific areas to consider and explain why they might be suitable?
Yeah. So at this stage, Brisbane had been through a massive boom cycle. So I'll talk about the councils rather than specifically a suburb as a pinpointing, because within that council, you can have a variety of the suburb which you can look at. At this stage, when you look at the Brisbane, right, look at don't just depend on the demand and supply, because there are a lot of suburbs within the Brisbane had been passed through affordability tests. Like if you go towards the Ipswich, the few pockets of Logan, or towards the Caboolture, the affordability is around 60 years. That means whatever the local people are earning versus the property prices have gone up to, there is significantly high positive gap, which is not good. So the buying affordability is extremely poor in that area, but there are still a lot of pockets where the property prices have significant growth remaining. Like if you go towards the Moreton Bay Council, like North Lakes, or if you go towards the Redland Bay Council, or if you go into the Gold Coast Council, and then Olympic Crescent, all the suburbs are in between 1 million, sorry, 950 to $1.5 million. But those suburbs has extremely high buying affordability plus the good socioeconomic indicator, and then demand and supply has a lot of gap, and there is enough demand from the owner occupier. So similar to the Perth, and Brisbane is witnessing a good growth cycle within the owner occupier, not because of the investor. Still, there is a good investors activity, but still there are a lot of pockets where wherever the owner occupier has a lot of demand, where the people are just paying there because of to live there, not because to invest. That's the pockets to get in, because now we are getting into a less than 4% rental yield. So capital growth would be a priority. If you want to invest in Brisbane, then strategically you have to put your asset into the Brisbane, because the cash flow will be very poor in a lot of suburbs.
Yeah. All right, guys, we are just close to 7:30, and I don't really think that we should exceed beyond 7:30. I'll just ask a couple of last questions, and then we'll call it a day. But I can tell you there are some 19 questions on the chat, and there are some 21 on the Q&A which we are not able to answer. But I would really sincerely request you if you can write to us directly. You can email, you can text, you can WhatsApp, you can call us up, whatever, and we'll be able to. We'll definitely want to answer your questions. But quickly, I'll just go in the sequence. Can you talk about Goulburn?
Goulburn data is looking good at this stage. Certainly, there are a few developments coming up. If your budgets are in between 700 to $900,000 with the rental yield of, if you can sustain a rental yield of 3.5 to 4% gross, then it's not a bad pocket to invest. But at this stage, within that price guide, you have a lot of other suburbs across Australia where your capital growth parameter will be much higher than Goulburn, and the rental yield will be very close to 4.8 to 5.2%. So it depends what your strategy is, but it's not a bad place to invest.
Okay, the last one. It's a different one. We've never been asked about this. So, what do you think about Dixon in Canberra?
Yes, so Canberra is a bit tricky at this stage. Market is under the recovery, but still there is a significant amount of recovery remaining into the market. So at this stage, if you're looking to invest into the Canberra, that is not the right time, because we would see certainly a good amount of dip into the property prices. If I can quickly check the score for the Dixon as per the R data sets, because we were following the Canberra markets to understand how the recovery is. The recovery is pretty poor. So
Yeah, true. Actually, while you look at it, see, Canberra market is driven a lot by people who work on in government employments and the demand which is created by them. And as and when the projects increase, do the requirements increase, and it changes from there as well. There are obviously other factors as well. It's not that one single straight line which I've spoken about, but the impetus market is there. That's why Canberra has it grows. Definitely it has grown in the last few years, but it has never shown the kind of growth which Sydney or Melbourne or a Perth or Adelaide has shown. Anyways, we'll go back to what Julius has to point out.
yeah, so if I look at the data for the Dixon, it's not that great. So days on market's extremely higher. Also, the percent sales growth is in negative. Uh, uh, Buying affordability is not extremely good. Uh, the socio-economic indicators are okay. Renting affordability is poor. Buying affordability is poor. Yield scores are not great. Um, at this stage, our total score for that suburb is around 62, which is okay. That means it's not the right market to get in now.
All right. There are, sorry guys, there are a lot of questions. Townsville, Rockhampton, Oran Park, Chester Hill, Epping, the heaps of them. Nowra, a lot of questions about various locations and a lot of follow-up questions on what we've already answered. But no, thank you very much for reaching out to us. Thank you very much for asking these questions. And it feels so nice when people are getting something out of it. We would sincerely request you if you can write to us directly, and we'll be more than happy to answer these questions. But it is already 8:30 right now, and it's a bit delayed, much beyond than what our webinar was slotted to. So thank you very much for coming. I hope you enjoyed, and I hope you learned something out of it. Reach out to us if you have any more questions, and we'll be happy to answer those. Thank you. Have a great night ahead, guys.
Thank you.